You're watching Navigate Your Wealth, brought to you by the team of Compass Financial. I'm your host, Kristin Oakley, here with the CEO, Karen Stawicki, and we are having an important conversation today to make sure that you can know how you can legally pay the least amount of tax to the IRS that you are required to pay. And Karen, a lot of this stems, as you shared in some of the previous stories in that first segment, of helping folks engage in Roth conversions, taking that tax-deferred money, meaning that it's going to be taxed on at some point, and converting it to tax-free dollars. We're talking about some of the common mistakes that folks make with Roth conversions, and the point is we don't want these simple mistakes to cost you even more money. That's why we're dedicating an entire show to talking through them. And this next one's really interesting. I think this is one that a lot of people might want to challenge you on, but I know you have the data to back this up. You've done the math, you've done the science. So we've got to talk about it. Mistake number 3 is not wanting my Social Security income to be taxable as a result of doing these Roth conversions. So let's talk about that.
Yes. Well, do you remember when Social Security used to be tax-free?
I remember stories of it for sure. I haven't collected one yet, but yes.
That's right. Well, it is no longer, for most of the people who are probably watching today, tax-free. Some portion of that income may be taxable.
Yes.
And the way that that happens is your adjusted gross income plus municipal bond income, which is interesting because it's tax-free, but somehow they decided it's going to be added into this calculation.
And count towards that.
It counts in that calculation. So it's your adjusted gross income plus the municipal bond income plus half of your Social Security. So that is the calculation that you must do. As a single tax filer, if you have over $25,000 of income with that calculation, then 50% of your Social Security income becomes taxable.
Right.
If that number goes over $34,000, then 85% is taxable. And as a married couple filing jointly, that number is $32,000, you get 50% taxable, and then $44,000, 85% is taxable. So here's the deal. You've got all of this money in these IRAs, and I can tell you story after story after story of how many clients. Remember, I've been doing this for 4 decades. So now the client finally gets to be 60 years old, and I say, great, you can take the money out. Do you want to set up a distribution? And they say, no. And I say, don't you need the money? And they say, well, it's taxable. And of course, my first response is, please tell me this is not the first time you realized that this money was going to be taxable.
Right.
The problem is you can run, but you can't hide. But here's what happens when you try to avoid having your Social Security taxable. You let that money sit there. And the IRS gives you permission from 60, 59 and a half, until the required minimum distribution age. Now, we know that number is shifting, 73, 74, 75, depending on what year you were born.
Right.
So you can kick the can down the road. Don't take any money out of that account. But what do you think those balances have gone to by the time now your required minimum distribution age?
They've grown significantly.
I hope so, right? If you've done a good job, they've grown significantly. And the amount that you're required to take out now pretty much is going to seal the deal that your Social Security will be taxable for the rest of your life. Let me ask you a question. Does it make more sense to, again, take that money out as quickly as possible, pay tax on your Social Security for a few years, and then have all of your money in the Roth IRA, which is 100% tax-free? You don't have to spend it if you don't want to. You don't have to take required minimum distributions out of it. And now you can let it grow, spend it, give it away, whatever you want, and now maybe your Social Security is tax-free again. Does a few years of paying taxes pay off for the many, many years that you would otherwise be paying? And here's the other problem. When you kick the can down the road from 59 and a half until 70, whatever it is, you didn't get to spend that money. Now, the other problem with that scenario is that every year you delay making those conversions, that account is getting bigger, and you just gave the IRS more money.
Exactly right. And I think that's the tragedy of all this, right? There's such a lack of education of really engaging in that strategic tax planning, which I know you and the entire team of Compass Financial, you really focus on that because it is so crucial. Folks don't have to be paying as much to the IRS as they are paying.
Well, and we always say, as much as we can help you pay the legally least amount, right?
Yep.
Because there is going to be some tax. We're going going to have to pay some tax.
Yeah.
But if you have the opportunity to pay, you know, $100,000 or $200,000, that sounds like a lot of money, but $100,000 or $200,000 in taxes versus $1 million in taxes, please take all the time you need to answer the next question. Would you rather pay $300,000 or $1 million?
Right, for
It's not the amount that you write in any single year that we focus on. It's your total tax over your lifetime that we want to bring to your attention and that deserves you paying attention to.
For sure. I want to go back because you shared that really powerful story of a woman that you're working with who's planning ahead for this. How did this Social Security piece of the conversation come into play with her situation?
Well, it was really interesting because when we did the whole cash flow analysis and we ran it all out and we showed how the conversions would happen, where she was going to pay the tax from, and ultimately when she retired and turned the income on, we realized that in running the numbers forward, 100% of her Social Security was the only thing that wasn't in a Roth IRA, and so she's going to fall below those numbers because half of her Social Security will start getting about $32,000. So half is $16,000. That's under the $25,000. She's single. That's under the $25,000 limit. So she's not subject to any income tax at all.
Wow, what a beautiful gift you've given her, for sure.
Yes.
Well, and here's the reality. You know, you've shown that it's possible that you don't have to pay tax on your Social Security benefit. Maybe this is news to you. Maybe you're even just starting to think about all these things and going, gosh, I didn't know that that was even a reality or possible, or that these strategies were available to you to help you pay the least amount that you are legally required to pay. Again, we are not talking about tax evasion. We are talking about lowering and limiting your tax liability using the tax code to your benefit. If that is something you would like help with, we invite you to pick up the phone and call the team of Compass Financial to schedule your complimentary retirement roadmap. To do so, all you need to do is call 855-348-3073. We should mention that these appointments are completely virtual. There's no cost, no charge, no obligation. It's simply an invitation to have a conversation to see how Compass Financial can help and serve you. Or again, if you'd like to scan that QR code, that will get you connected as well. We still have one key mistake to cover. Stay with us. We'll cover that one when we come back.